Question 1. What is the primary difference between level term and decreasing term life insurance? A. Level term insurance provides a fixed death benefit, while decreasing term insurance reduces the death benefit over time. B. Level term insurance has a higher premium than decreasing term insurance throughout the policy. C. Decreasing term insurance allows for a cash value accumulation, while level term does not. D. Level term insurance is convertible to permanent insurance, whereas decreasing term is not. Answer A. Level term insurance provides a fixed death benefit, while decreasing term insurance reduces the death benefit over time. Explanation. Level term life insurance maintains a constant death benefit for the duration of the policy, making it ideal for individuals who want a predictable payout to beneficiaries, especially during specific financial obligations like a mortgage. In contrast, decreasing term life insurance is structured to have a death benefit that declines over the term of the policy, typically used to cover obligations that decrease over time, such as loans. According to the Oregon Insurance Code, this distinction is crucial for consumers to understand when assessing their needs for life insurance coverage. Question 2. Scenario question. Mr. Thompson is 45 years old and is considering purchasing a term life insurance policy to cover his family's expenses in case of his untimely death. He is particularly concerned about ensuring that his policy will not be contested later due to any mistakes made during the application process. What should Mr. Thompson prioritize when selecting a policy? A. Choosing a policy with the lowest premium to save money. B. Ensuring the policy includes an incontestability clause. C. Selecting a decreasing term policy to align with his mortgage payment schedule. D. Opting for a policy that offers multiple riders for additional coverage. Answer. B. Ensuring the policy includes an incontestability clause. Explanation. An incontestability clause is a provision in life insurance policies that prevents the insurer from denying a claim based on misstatements or omissions made by the insured after the policy has been in force for a specified period, usually 2 years. This clause provides peace of mind for policyholders like Mr. Thompson, knowing that minor errors in the application process will not affect the payout to beneficiaries. The Oregon Insurance Code supports this protection for consumers, making it a critical consideration in policy selection. While low premiums and additional riders are also important, they do not address the core concern of contestability that Mr. Thompson has. Question 3. Which of the following statements best describes the underwriting process for term life insurance? A. Underwriting is solely based on the applicant's income and employment status. B. Underwriting evaluates the applicant's health history and lifestyle choices to assess risk. C. Underwriting focuses only on the applicant's age to determine eligibility. D. Underwriting is a straightforward process that requires minimal documentation from the applicant. Answer. B. Underwriting evaluates the applicant's health history and lifestyle choices to assess risk. Explanation. The underwriting process is a comprehensive evaluation that considers various factors to determine an applicant's insurability and premium rates. Insurers analyze health history, lifestyle choices, such as smoking and exercise, and sometimes even family medical history to assess the risk of insuring the individual. This detailed assessment helps ensure that the premiums charged align with the level of risk posed by the applicant. In Oregon, the underwriting guidelines are established to protect both consumers and insurers, ensuring a fair assessment of risk while promoting access to life insurance coverage. The focus is not solely on income, age, or minimal documentation, as these aspects do not provide a complete picture of the applicant's risk profile. Question 4. What is a common reason for a claim denial in a term life insurance policy? A. The insured passed away during the grace period. B. The policy had an incontestability clause that had not yet taken effect. C. The insurer found material misrepresentation in the application. D. The insured failed to designate a beneficiary. Answer. C. The insurer found material misrepresentation in the application. Explanation. Material misrepresentation occurs when the applicant provides false or misleading information that affects the insurer's decision to issue the policy. If an insurer discovers such misrepresentation, particularly regarding health status or lifestyle choices, they can deny a claim even after the policy is in force. The Oregon Insurance Code mandates that insurers conduct thorough investigations to ensure that claims are valid. However, if discrepancies are identified in the application, it can lead to claim denial. Claims filed during a grace period or issues regarding beneficiary designation typically do not lead to outright claim denials, especially if the policyholder is compliant with policy terms. Question 5. Which of the following statements regarding the conversion option in a term life insurance policy is true? A. The conversion option allows the policyholder to change their term policy into a whole life policy without additional health assessments. B. The conversion option must be exercised within the first year of the policy issuance. C. A conversion option typically requires the policyholder to pay an additional fee for the conversion. D. The conversion option is not available for decreasing term policies. Answer A. The conversion option allows the policyholder to change the term policy into a whole life policy without additional health assessments. Explanation. The conversion option in term life insurance permits policyholders to convert their term policy to a permanent policy such as whole life or universal life without undergoing a new medical examination. This is advantageous for individuals who may have developed health issues during the term period, as it guarantees insurability. This option is typically available until the end of the term or until the insured reaches a certain age, depending on policy specifics. While a conversion fee may be involved, it does not usually negate the primary benefit of bypassing health assessments. Decreasing term policies may offer conversion options, although specifics can vary by insurer. Question 6. In the context of life insurance, what does underwriting primarily assess? A. The potential for future health risks based on family history only. B. The current health status and lifestyle choices of the applicant. C. The applicant's financial history and credit score. D. The investment potential of the premium payments made by the insured. Answer. B. The current health status and lifestyle choices of the applicant. Explanation. Underwriting is the process through which insurers evaluate the risk associated with insuring an individual based on their current health status and lifestyle choices, including factors such as smoking, occupation, and participation in risky activities. This assessment helps determine the insurability and premium rates for the policy. Although family history and financial aspects can be considered in underwriting, the primary focus is on the individual's current health and behavior, which are most relevant to life expectancy and potential claims. Question 7. Scenario question. MS. Garcia, a 38-year-old non-smoker, is evaluating her term life insurance options. She has a spouse and 2 children, and her financial advisor recommends a policy that includes an accelerated death benefit rider. What is the primary advantage of this rider for MS? Garcia. A. It provides coverage for accidental death only. B. It allows her to access a portion of the death benefit if diagnosed with a terminal illness. C. It guarantees that her premiums will remain the same throughout the term. D. It permits the conversion of the policy to permanent insurance at any time. Answer. B. It allows her to access a portion of the death benefit if diagnosed with a terminal illness. Explanation. The accelerated death benefit rider allows policyholders to receive a portion of their death benefit while still alive if they are diagnosed with a terminal illness, which can significantly help cover medical expenses and other financial needs during a critical time. This rider does not restrict coverage to accidental death, guarantee premium stability, or necessarily allow for conversion. Including this rider can be a crucial aspect of financial planning, especially for parents like MS. Garcia, as it provides additional financial security in the face of serious health issues. Question 8. Which of the following is not typically considered a consumer protection under Oregon's life insurance regulations? A. The right to free look period after the policy is issued. B. Prohibition against unfair discrimination in underwriting. C. Mandated annual premium adjustments for term policies. D. Requirements for clear disclosures of policy terms and benefits. Answer. C. Mandated annual premium adjustments for term policies. Explanation. Oregon's insurance regulations include consumer protections such as a free look period, which allows consumers to review their policy and return it for a full refund within a specific time frame if they are unsatisfied. They also prohibit unfair discrimination in underwriting practices, ensuring fair treatment across applicants. However, there is no requirement for annual premium adjustments for term policies, as these premiums are typically fixed for the duration of the term. Clear disclosures of policy terms and benefits are required to ensure consumers make informed decisions. Question 9. In determining the appropriate coverage amount for term life insurance, which factor is most critical? A. The average cost of living in the insured state. B. The insured's current salary multiplied by a predetermined factor. C. The insured's outstanding debts and financial obligations. D. The average mortality rate for individuals of the same age. Answer. C. The insured's outstanding debts and financial obligations. Explanation. Determining the appropriate coverage amount involves a thorough analysis of the insured's financial situation, which includes their outstanding debts, such as mortgages, personal loans, and credit card debts, and financial obligations like dependents' education costs and daily living expenses. While salary and mortality rates can provide context, they do not directly address the immediate financial responsibilities that need coverage. A needs analysis helps ensure that beneficiaries are not left in financial distress in the event of the insured's death, making it the most critical factor in determining coverage. Question 10. What does the term grace period refer to in a term life insurance policy? A. The period during which your policyholder can convert their policy to a permanent one without penalty. B. The time allowed for the policyholder to pay overdue premiums without losing coverage. C. The duration the insurer has to investigate a claim before payment is made. D. The time frame during which beneficiaries can file a claim after the insured's death. Answer. B. The time allowed for the policyholder to pay overdue premiums without losing coverage. Explanation. The grace period in life insurance refers to the time frame, typically 30 days, during which a policyholder can pay their overdue premiums without risk of policy lapse. If the insured dies during this grace period, the insurer must pay the death benefit minus any unpaid premiums. This provision is critical for consumer protection and ensures that unintentional lapses in coverage do not leave beneficiaries without financial support. Other options regarding conversion, claims investigations, or filing timelines do not accurately describe the grace period's function in life insurance policies. Question 11. Which of the following best describes the difference between level term and decreasing term life insurance? A. Level term insurance maintains the same premium while decreasing term insurance has decreasing premiums. B. Level term insurance pays out a fixed benefit amount while decreasing term insurance pays out a benefit that decreases over time. C. Level term insurance is more expensive than decreasing term insurance, regardless of coverage amount. D. Level term insurance can be converted to a permanent policy, while decreasing term insurance cannot. Answer. B. Level term insurance pays out a fixed benefit amount, while decreasing term insurance pays out a benefit that decreases over time. Explanation. Level term life insurance provides a fixed death benefit amount throughout the term of the policy and maintains consistent premium payments. In contrast, decreasing term life insurance features a death benefit that decreases at predetermined intervals, typically aligning with the diminishing financial obligations of the insured, such as a mortgage. This type of policy is often less expensive than level term insurance due to the reducing coverage. However, both policies generally maintain fixed premiums during their respective terms. Understanding these differences is crucial for consumers seeking appropriate coverage based on their financial needs and obligations. Question 12. In Oregon, which of the following must be included in the insurance policy to meet the legal requirements for consumer protection? A. A detailed explanation of the underwriting process used by the insurer. B. A clear description of the policy's exclusions and limitations. C. An automatic renewal clause for all term policies. D. A list of all possible riders and endorsements available to the policyholder. Answer. B. A clear description of the policy's exclusions and limitations. Explanation. Under Oregon law, life insurance policies must include a clear description of exclusions and limitations to ensure that consumers understand the conditions under which benefits may not be payable. This transparency is essential for consumer protection as it helps prevent misunderstandings regarding coverage, while a description of the underwriting process, details about riders, and automatic renewal clauses may be beneficial. They are not legally required components for clarity and policy documentation. The focus on exclusions and limitations safeguards consumers from unexpected denials of coverage. Question 13. Scenario question. Mr. Thompson is 45 years old and is considering purchasing a term life insurance policy. He has a history of high cholesterol and is concerned about how this might affect his application. What is the most likely outcome of Mr. Thompson's application based on his health status? A. He will be automatically declined coverage due to his health history. B. He may be offered a policy with a higher premium due to increased risk. C. He will receive the same premium rate as a healthy applicant. D. He can opt for a no medical exam policy guaranteeing coverage. Answer. B. He may be offered a policy with a higher premium due to increased risk. Explanation. When applying for life insurance, the underwriting process assesses the applicant's health risks, including any pre-existing conditions like high cholesterol, While Mr. Thompson may not be automatically declined coverage, insurers may categorize him as a higher risk, resulting in increased premium rates. Insurers utilize medical underwriting to evaluate the risk, which can lead to modified terms or exclusions but does not necessarily lead to denial of coverage. While no medical exam policies exist, they typically come with higher premiums and may have stricter limitations. Question 14. Which of the following accurately describes the term incontestability clause ECA life insurance policy? A. It allows the insurer to deny claims if the insured dies during the first year of coverage. B. It prevents the insurer from questioning the validity of the policy after a specified period, usually 2 years. C. It mandates that policyholders must prove insurability every year to maintain coverage. D. It ensures that premiums will never increase regardless of changes in the insured's health. Answer. B. It prevents the insurer from questioning the validity of the policy after a specified period, usually 2 years. Explanation. The incontestability clause is a critical provision in life insurance policies that protects policyholders and beneficiaries by stipulating that after a specific period, typically 2 years, the insurer cannot contest the policy's validity based on misrepresentation or material misstatements made during the application process. This clause fosters trust in the insurance contract, ensuring that even if a misrepresentation occurs, the insurer cannot deny a claim after the contestability period. Options regarding denial of claims in the first year, annual proof of insurability, or premium stability do not accurately reflect the purpose of the incontestability clause. Question 15. Which of the following best describes the waiver of premium rider in a term life insurance policy? A. It allows the policyholder to waive premiums if they are diagnosed with a critical illness. B. It automatically converts the policy to permanent insurance if the insured becomes disabled. C. It allows the policyholder to stop paying premiums without losing coverage during periods of financial hardship. D. It waives premiums if the policyholder becomes disabled for a specified period. Answer. D. It waives premiums if the policyholder becomes disabled for a specified period. Explanation. The waiver of premium rider enables policyholders to have their premiums waived if they become disabled and unable to work for a specified duration, typically 6 months. This rider is beneficial for individuals concerned about maintaining their insurance coverage during times when they may not have an income due to disability. It does not automatically convert the policy to permanent insurance or address critical illness diagnoses unless specifically stated in a separate rider. This provision is designed to ensure that policyholders do not lose coverage due to their inability to pay premiums because of disability. Question 16. When assessing the suitability of a term life insurance policy, which of the following factors should be considered most critically? A. The insurer's marketing strategy. B. The policyholder's long-term financial goals and obligations. C. The average cost of term life insurance in the market. D. The insurer's historical performance ratings from independent agencies. Answer. B. The policyholder's long-term financial goals and obligations. Explanation. The primary factor in assessing the suitability of a term life insurance policy is understanding the policyholder's long-term financial goals and obligations. This analysis includes evaluating current debts, anticipated expenses such as children's education, and overall financial stability. While market costs and insurer performance are relevant considerations, they should not overshadow the need to align the policy with the insured's specific financial situation and objectives. Insurers can offer a variety of products, but the best policy is one that meets the individual's unique needs. Question 17. Which of the following statements about term life insurance is false? A. Term life insurance provides coverage for a specified period of time. B. Term life insurance typically has a cash value component. C. Premiums for term life insurance are usually lower than those for whole life insurance. D. Term life insurance can be renewed or converted to permanent coverage in some cases. Answer. B. Term life insurance typically has a cash value component. Explanation. Term life insurance is designed to provide coverage for a specified period, e.g. 10, 20, or 30 years, and does not accumulate cash value like whole life insurance. The premiums for term life insurance are generally lower than for permanent policies because it only pays out if the insured dies during the term, while many term policies offer options for renewal or conversion to a permanent policy. The absence of a cash value feature distinguishes term life insurance from whole life products. Question 18. In the context of Oregon life insurance regulations, what is the maximum age limit for an insurer to contest a claim based on misrepresentation? A. 1 year from the date of issue. B. 2 years from the date of issue. C. 5 years from the date of issue. D. There is no age limit. Claims can be contested indefinitely. Answer. B. 2 years from the date of issue. Explanation. Under Oregon law, insurers are limited to a 2-year period from the day of issue to contest a claim based on misrepresentation or fraud. This provision is established to protect consumers by ensuring that once the policy has been in effect for 2 years, the insurer cannot retroactively deny claims based on the information provided in the application, promoting stability and trust in insurance contracts. While some states may have different rules, Oregon's 2-year standard is widely recognized as a consumer protection measure. Question 19. What is the primary function of mortality tables in the context of life insurance? A. They determine the investment returns for life insurance premiums. B. They calculate the likelihood of a claim being filed for a specific policy. C. They assess the risk associated with insuring individuals of various ages. D. They help policyholders choose between term and permanent life insurance options. Answer. C. They assess the risk associated with insuring individuals of various ages. Explanation. Mortality tables, also known as actuarial tables, provide statistical data about the expected lifespan and death rates of individuals within certain age groups. These tables are crucial for insurers in determining premium rates and evaluating risk profiles for applicants. By understanding the likelihood of mortality at various ages, insurers can more accurately price policies to ensure they remain financially solvent while providing appropriate coverage to policyholders. The other options do not accurately represent the primary role of mortality tables in life insurance underwriting. Question 20. Which of the following factors does NOT typically influence the underwriting decision for a term life insurance policy? A. The applicant's medical history and current health status. B. The applicant's age and gender. C. The applicant's occupation and hobbies. D. The applicant's social media activity. Answer. D. The applicant's social media activity. Explanation. When underwriters assess an application for a term life insurance policy, they typically consider the applicant's medical history, current health status, age, gender, occupation, and hobbies, as these factors directly impact the applicant's risk profile. While certain occupations or hobbies might increase risk, e.g. extreme sports, social media activity is generally not a standard factor influencing underwriting decisions. Insurers focus on measurable and relevant factors that can help predict the likelihood of claims, making social media activity an unlikely consideration in the underwriting process. Question 21. Which of the following riders allows a policyholder to receive a portion of the death benefit while still alive under specific circumstances? A. Waiver of premium rider. B. Accelerated death benefit rider. C. Child rider. D. Conversion option rider. Answer. B. Accelerated death benefit rider. Explanation. The accelerated death benefit rider allows policyholders to access a portion of their life insurance benefits while still alive if they meet certain criteria, such as a terminal illness diagnosis. This rider provides financial assistance during critical times, helping policyholders manage medical expenses or other financial burdens. In contrast, the waiver of premium rider allows premiums to be waived if the policyholder becomes disabled, but it does not provide early access to death benefits. Question 22. In the context of Oregon's insurance regulations, which of the following statements about consumer protections is most accurate? A. Insurers are not required to disclose underwriting criteria to applicants. B. Applicants must be informed of their rights to appeal. A claim denial. C. All life insurance policies are automatically guaranteed renewable. D. Policyholders can cancel their policies without any notice period. Answer. B. Applicants must be informed of their rights to appeal a claim denial. Explanation. Oregon's insurance regulations emphasize consumer protections, including the requirement for insurers to inform applicants of their rights regarding claim denials. This transparency ensures that consumers are aware of their rights to appeal and seek further clarification or action if their claims are denied. Other statements, such as not disclosing underwriting criteria or automatic guarantee of renewals, do not align with the regulations aimed at protecting consumers. Question 23. Mr. Thompson has a 20-year term life insurance policy with a face amount of $500,000. After 10 years, he is diagnosed with a terminal illness and decides to utilize the accelerated death benefit rider in his policy. What impact will this decision have on the death benefit payable to his beneficiaries? A. The beneficiaries will receive the full $500,000 at Mr. Thompson's death. B. The beneficiaries will receive a reduced death benefit as the amount accessed will be deducted. C. The policy will be voided and no benefits will be paid. D. The death benefit will increase to cover the amount accessed. Answer B. The beneficiaries will receive a reduced death benefit as the amount accessed will be deducted. Explanation. When Mr. Thompson utilizes the accelerated death benefit rider, he can access a portion of his death benefit while still alive, which is typically subject to the terms of the rider and policy. This means that the amount he receives will be deducted from the total death benefit available to his beneficiaries upon his death. If he accessed $100,000, for example, his beneficiaries would receive $400,000, $500,000, $100,000 at the time of his passing. Question 24. Which of the following accurately describes the term level term life insurance? A. The coverage amount decreases over time. B. The premiums remain constant throughout the term of the policy. C. It provides coverage for the lifetime of the insured. D. The coverage is only available for individuals under age 50. Answer B. The premiums remain constant throughout the term of the policy. Explanation. Level term life insurance is characterized by a fixed premium and a constant coverage amount throughout the term of the policy. This predictability allows policyholders to plan their budgets without concerns about increasing premiums. In contrast, decreasing term life insurance has a coverage amount that decreases over time, while permanent life insurance provides coverage for the insured's lifetime. Question 25. Under the Oregon Insurance Code, what is the maximum grace period for premium payments on a term life insurance policy before a policy lapses? A. 10 days. B. 30 days. C. 60 days. D. 90 days. Answer B. 30 days. Explanation. Oregon's regulations stipulate a maximum grace period of 30 days for premium payments on life insurance policies, including term life insurance. During this period, the policy remains in force, allowing policyholders to make late payments without the risk of the policy lapsing. If payment is not made within the grace period, the policy may lapse and coverage would cease unless reinstatement provisions apply. Question 26. Which of the following factors would most likely be considered during the underwriting process of a term life insurance policy? A. The applicant's credit score. B. The applicant's family history of health conditions. C. The applicant's geographic location. D. The applicant's lifestyle choices, such as diet and exercise. Answer B. The applicant's family history of health conditions. Explanation. Underwriters assess various factors to determine the risk profile of an applicant, with the applicant's family history of health conditions being a significant consideration. A family history of serious illnesses can indicate potential future health issues for the applicant, affecting their insurability and premium rates. While lifestyle choices may also be relevant, family history is often weighted more heavily in the underwriting decision-making process. Question 27. Which of the following is a primary responsibility of the Oregon Department of Consumer and Business Services regarding term life insurance? A. Setting premium rates for all insurers. B. Regulating the marketing practices of insurers to prevent misleading advertisements. C. Guaranteeing the approval of all insurance applications. D. Providing direct insurance coverage to residents. Answer B. Regulating the marketing practices of insurers to prevent misleading advertisements. Explanation. The Oregon Department of Consumer and Business Services plays a crucial role in protecting consumers by regulating marketing practices, ensuring that insurers do not engage in misleading advertisements. They oversee compliance with state laws and regulations, but do not set premium rates or guarantee the approval of applications. The department also does not provide direct insurance coverage to individuals. Question 28. What is the primary advantage of converting a term life insurance policy to a permanent policy using the conversion option rider? A. The policyholder can increase the death benefit without additional underwriting. B. The policyholder pays lower premiums for the permanent policy. C. The policyholder can choose a different insurer for the permanent policy. D. The policyholder gains access to cash value accumulation immediately. Answer A. The policyholder can increase the death benefit without additional underwriting. Explanation. The conversion option rider allows policyholders to convert their term life insurance policy to a permanent policy without undergoing additional underwriting. This is particularly advantageous for individuals who may have developed health issues during the term, as they can secure permanent coverage without being subjected to potentially higher premiums due to their altered health status. While the premiums for permanent insurance may be higher than for term insurance, the ability to increase coverage without requalification is a significant benefit. Question 29. What is the role of mortality tables in the context of term life insurance? A. They help insurers determine the cost of marketing insurance products. B. They provide a basis for calculating premiums based on life expectancy. C. They assess the impact of economic conditions on insurance claims. D. They evaluate the investment returns on premiums collected. Answer. B. They provide a basis for calculating premiums based on life expectancy. Explanation. Mortality tables are critical actuarial tools used in life insurance to estimate the likelihood of death at various ages. Insurers use this information to calculate premiums, ensuring that they can adequately cover potential claims. Understanding mortality rates allows insurers to set premiums that reflect the risk associated with insuring individuals of different ages and health statuses. Question 30. Which of the following statements about the claims process for term life insurance policies is accurate? A. Claims must be filed within 90 days of the policyholder's death, regardless of the circumstances. B. The insurer has the right to deny a claim without conducting an investigation. C. The death benefit must be paid within 30 days of claim approval. D. Beneficiaries are required to submit the policyholder's medical records with every claim. Answer. C. The death benefit must be paid within 30 days of claim approval. Explanation. Under Oregon law, once a claim is approved, the insurer must pay the death benefit within 30 days. This ensures timely compensation to beneficiaries after the insured's death. Claims must generally be filed according to the policy terms, and while insurers may conduct investigations, they cannot arbitrarily deny claims without just cause. Beneficiaries are not typically required to submit the policyholder's medical records unless specified by the insurer.